Hello, and welcome to FastPass University, the only place where you can learn all of your insurance exam content free state by state. No paywalls, no giant courses you're forced to buy, just clear lessons that help you pass fast. Today, we are covering New York laws, statutes, and regulations that are common to all insurance exams. So, whether you're taking life and health, property and casualty, personal lines, or just one of those lines on their own, this section will show up on every single one of those exams, and it is one of the most heavily tested parts of your exams and one of the most confusing. So we're going to help break that down for you. This is part one, the foundation. Everything else in your state-specific exam builds on the rules and responsibilities that we cover here. If you are studying for property and casualty or life and health, this video is required, but it is not the only one you will need. After this, you're going to want to also watch part two, which will cover the laws and regulations specific to your line of authority, specific to your exam. So there will be a part two for property and casualty and a part two for life and health. I will link those in the description. We're going to break down what the exam actually tests on and explain those concepts in an easy way and point out what you need to remember for test day. So always know that you can download the matching workbooks, take practice exams, or join our study community anytime at fastpassuniversity.co. That is .co. All right, so let's get into it. Before we jump into the New York insurance regulations, I do want to recommend that you do go through your insurance content first before working on regulations. It should be one of the last sections that you learn. It's important to understand all of the basics and terms on insurance and how policies work, etc., and then move on to regulations. There are certain things that we will go over that you should already know from your other content. You can check out our videos and see if we have dropped those yet, because we are releasing every week, state by state, the regulations as well as all of the content in the exams or wherever you are studying. And if you need a course, you can always get one on our site. We partner with WebCE, where you'll get 10% off and 20% off of tutoring as well. But we will go over some sections. I'll recap, review a bit, but it's important to have a solid understanding on insurance in general before working on regulations. So, all right, let's go. Understanding insurance producers. Okay, so when you see the word producer, you should know that that is interchangeable with agent. Insurance agents, insurance producers, that's what you will all be when you pass your exam. And the definition of a producer or agent is a person who sells, solicits, or negotiates insurance on behalf of an insurer. Okay. Another term that also means selling, soliciting, or negotiating insurance is transact. To transact insurance or transacting. Okay. So if you sell, solicit, or negotiate insurance, that is considered transacting insurance, and you must be licensed to do so, and that would make you a producer or an agent. Selling is completing transactions, soliciting is seeking applications, and negotiating is discussing terms or making adjustments to the policy. Home state concept. The state where the producer maintains their principal residence or principal place of business would be where you get your home state license, your resident license. Okay. I imagine that most of you here are residents of New York, so it would be your resident license. Now, you can get licenses in other states because in order to sell, solicit, or negotiate insurance, you must be licensed in whichever state you are doing so. There are a lot of insurance agents that are licensed in multiple states, but any other state besides their resident would be a non-resident license. And a lot of states have reciprocity. So normally, if you are licensed in your home state, they consider it you qualify to be licensed in their state as well, you can go online and apply for your non-resident license. A lot of times, especially with life and health, insurance agents are licensed in multiple states, so it's pretty simple online. If there is a state that has stricter requirements, you may have to take a couple hours of a course, etc., but you can figure all of that out. But just know that your home state license is your resident license. And if you wanted to be licensed in another state, it would be a non-resident license. Exam tip: if you are paid to sell, solicit, or negotiate insurance, you usually need a license. We are going to cross out that word usually and just say you must. All right. Types of insurance licenses. Agent, right? And that's what we just talked about. That's what you are going to be when you pass your exam. Or producer. You represent the insurer and act on their behalf and has authority to bind coverage. Binding coverage is just, completing the policy, making it official. Once the policy is bound, it becomes that, legal contract. And while you do need to do what is in the best interest of your customers at all times, it is considered that the agent or the producer represents the insurer. Okay. And they like to ask that exam question: who does the agent represent in an insurance transaction? Who does the agent represent or the producer represent? The insurer. And while you should know this is going to be one of those things that we kind of recap right now. Insurer, if it ends in ER, is the insurance company that you work for. Okay. Insured, if it ends in ED, is the customer or policyholder. And the way I like to remember that, the ED at the end, I think of Ed. Think of a man named Ed. Ed is insured. And even after 15 years in the insurance industry, I still have to kind of say that to myself when I'm reading questions. So make sure when you are reading questions, whether they are asking for the insurer or the insured, because the answer is going to vary. And that is one of the most common mistakes, is people reading it too quickly and answering the question incorrectly because they were thinking of insurer versus insured or vice versa. Okay. An insurance broker, on the other hand, represents the insured. Okay. Not the insurer. They place businesses with multiple carriers. So insurance brokers are usually not captive to just one insurance company. They work with multiple insurance companies and they represent the insured and try to shop out the best policies for them. So if they were to ask you, who does the broker represent in insurance? It is the insured. All right. A consultant is anyone who provides advice for a fee, but they may not sell policies directly. They would still need to be licensed. If they are providing advice for a fee, even if they are not selling policies, they must be licensed. There are also adjusters. An adjuster license would be in addition to your property and casualty license, etc. They investigate and settle insurance claims on behalf of insurers. Now, if you are taking your adjuster's exam, the state laws and regulations section is going to be exactly identical, so you're still in the right place, but you would be taking a different exam. Non-resident producer, like we were speaking about on the last slide, is licensed in another state but seeking to do business in New York. So if somebody is licensed in California and they want to sell business in New York, it would be a non-resident producer. And if you also own your own business, so if you are getting your insurance license to then open up your own agency, you would also need a business entity license, a company or organization that must be licensed to sell insurance. All right, let's continue on. All right, now we are going to start getting into some of the actual laws and regulations and numbers and such. So there are a couple different types of special situations or license types. And the first one would be a temporary license. Number one question you're going to see on this is, how long are temporary licenses good for? and they are good for 180 days. Or they may ask you, in which situations are temporary licenses issued? And that is in cases of death or disability of a producer, allowing for business continuity. So temporary licenses are unique. Most states do offer them, and they are only in the event of a producer's death or disability in which they need to issue a temporary license to let the business continue on as such. Um, so imagine that an agent has, been an insurance agent for 20 something years. His wife is, a retired school teacher. She's never read a thing about insurance a day in her life. But that her husband passed away or had a disability. Well, his entire book of business um, needs to be taken care of, right? And if you are not licensed, you can't make any changes to a policy. You can't write new policies. You can't add a car, anything like that. So, in instances like that, the state of New York will issue a temporary license for 6 months, 180 days to the spouse or to the chosen person. Maybe it's a dependent or a spouse or, a business partner, etc. And it will give them 180 days so that they can keep business flowing. But within that 180 days, they must either get licensed themselves or appoint somebody that is. They cannot be renewed. They're giving you 6 months to grieve and adjust and make changes and keep the business flowing. But yeah, within that 6 months, within that 180 days, either that person needs to become licensed themselves or appoint somebody that is. Assumed names. Producers may use a business name other than their legal name if it is properly registered with the superintendent, which we're going to get into that in a bit. And license renewals. Licenses must be renewed every 2 years by completing continuing education requirements. And we're going to dive deeper into that here in a sec. So, most important here, temporary license, good for 180 days, only in the event of death or disability of a producer to allow business continuity, and they cannot be renewed. Okay, maintaining your license. So, as we just said on the last slide, one, you must know this so that you can renew your license every 2 years. If you pass your exam, when you pass your exam, as long as you keep up with your continuing education and your renewals, you never, ever, ever have to sit for this exam again. So you want to make sure that you complete these. We'll go over the continuing education hours on the next slide, but as we said, the renewal period is 2 years. You must know that number. Very, very likely that they're going to check your understanding for that. And that you must complete your continuing education within those 2 years. The other very, very important number on this slide is the 30 days. So for any address changes or disciplinary actions, you must notify the superintendent, which the superintendent is just the head of the Department of Insurance in New York, within 30 days of any change to your physical address or email address or name. So if you got married or divorced or had a name change, you must report that to the Department of Insurance, to the superintendent within 30 days, as well as any disciplinary actions in which criminal charges are placed against you. You need to let them know within 30 days. If you do not do so, there are fines and penalties. You could get your license suspended, all types of things. Exam tip, missing the 30-day reporting deadline is a common test question, okay? You want to make sure that you know that number. So 2 years and 30 days to report. On top of that, like I just said, as long as you keep up with your continuing education and do your renewals, you never ever have to sit for the exam again. Don't be like me, where I always forget that it is time to do my continuing education or that it's time to renew. And I get something in the mail and I get an email from the state telling me it's time to, your renewal is coming up in 60 days. Make sure that you complete your continuing education. And then I'm scrambling to get it done. But if I changed my email or changed my address, it'd be very, very likely that I would completely forget and my license would not renew and I would have to sit for the exam again. So another important reason on why you want to make sure that they know where you are to get a hold of you. So 30 days. Okay, continuing education requirements. All right, so producers must complete 15 hours of CE every 2 years, and that is for single lines, okay? Most people are taking dual licenses. Normally, you're taking life and health together or property and casualty together. So that would be 30 hours, and that is for dual lines. A line of authority is like life. Life insurance is a line of authority. Property is a line of authority. Property and casualty is a dual line because it's both property and casualty. Okay, so make sure when you're reading the question that you know if they are asking for a single line or a dual line because that number is going to vary, right? Within those, whether it's the 15 or 30, you must complete 1 hour of New York insurance law, 1 hour of ethics and professionalism, and 1 hour of diversity, inclusion, and elimination of bias. So that does not mean 15 plus these 3 hours. It means out of those 15, 3 of them must be in these items. And if it's the 30 hours, the dual lines, you still only, it's only the 3 hours. You don't need to take these twice. Okay. And that it's one of them is in law, one of them is in ethics, and one is in diversity. Now, when you go sign up for a continuing education course, they usually have it all bundled so that you can meet the requirements of exactly what you need. Again, we partner with WebCE, so you can check out our course once our website when you need those. All right. Now, we will dive a little bit deeper into this when we are speaking specifically for P&C or life and health, but there are some specialized training additional requirements. So this would be plus. So this would be 15 plus or 30 plus. So they would need to take, if you're doing P&C, you would need plus 1 hour of training for selling federal flood policies. And if you're taking life and health, and you want to sell annuities, you would need to take plus a 4-hour annuity training. All right, so 2 years. That's how good the license is for. CE is 15 for a single line, 30 for a dual line, with 3 of those being law, ethics, and diversity. And how long do you have to report any changes? 30 days. Okay, very likely that you could see multiple questions on the things that we just went over. So make sure that you've got a solid concept on those. Make your flashcards, write them down in your notes. Get comfortable with those numbers and timeframes. All right, quick check. Licensing basics. Who represents the insurer in a transaction? Think about which party has binding authority. That would be the producer or agent. Okay. But if we were asking about a broker, which they're generally not, they're going to be most likely asking about producer or agent, and that's when you represent the insurer. But they could ask about the broker. In that situation, they represent the insured. What triggers the licensing requirement? Consider the 3 activities. If you are going to sell, solicit, or negotiate, or transact insurance, you must be licensed to do so. And how long does a temporary insurance license last? 180 days. And that is only in the instance of death or disability of an agent for business continuity. All right, so moving on. State regulation and the superintendent. So the head of the Department of Insurance in New York is called the superintendent. In other states, they have different titles: commissioner, director, etc. You need to know that that is called the superintendent in your state. If you are reviewing material before you get into your New York specific material and they are talking about the commissioner or the director, they mean the same thing as your superintendent, but they are called the superintendent in New York. So if you're reading through and they're talking about the responsibilities and duties of a commissioner or a director, just know when you hear that word that you need to switch it to superintendent in your mind. So they are called the superintendent in New York. They head the Department of Financial Services and the Department of Insurance. And then that Department of Insurance oversees all insurers, producers, and consumers, because the number one job of the superintendent is to protect consumer interest. Okay, the superintendent of financial services heads the regulatory authority in New York, overseeing all insurance activities and protecting consumer interests. Protect consumers, protect the public. Okay, insurance is confusing, right? Think of all that you're going through, learning what you're learning now, right? This is not just common knowledge. So, to the general public out there buying insurance policies, they don't have nearly as much of a background as you do on this. So, there needs to be somebody, and a whole team of somebody's actually overseeing the insurance industry, regulating it, making sure that agents and insurance companies are doing what's right and out there protecting the public. And so that is what the Department of Financial Services, the Department of Insurance does, and the head of that department is called the superintendent. Now, I did say the number one job of the superintendent is to protect consumers, but how they do that is broken down into a little bit more. And you want to make sure that you are comfortable with the powers and duties of the superintendent, because they could ask you, the superintendent does all of the following except, and throw in some other things to throw you off. So you want to make sure that you are comfortable with the powers and duties of the superintendent. So the superintendent issues and revokes certificates of authority, okay, as well as licenses. But let's talk about a certificate of authority for a sec. The certificate of authority is basically the license for insurance companies. It is their ticket to transact. Now remember, we said transacting is if you are selling, soliciting, or negotiating insurance contracts, that is considered transacting insurance. So in order to be able to transact insurance, they need their certificate of authority. Okay? It is the insurance company's license, to say the least. Okay? So an agent, so this is insurance companies, an agent or producer needs a license. An insurance company needs a certificate of authority in order to transact business in the state. Okay? And if an insurance company has a certificate of authority, so let's just pretend this is the certificate of authority badge, or their ticket to transact, they are considered admitted or authorized. And you need to know those two terms. They could ask you if an insurance company is admitted to transact insurance in the state of New York. What are they also considered? Authorized. If they are authorized, what are they also considered? Admitted. So the question could simply be asking you if you know that these two terms go together. Or if they say, what does an insurance company need to have to be admitted or authorized to transact insurance in the state, then they would need a certificate of authority. Now, there is also the terms non-admitted. Let's draw lines so you know that this is separate. Non-admitted or unauthorized. Just like admitted and authorized go hand in hand, so do non-admitted or unauthorized. So if they could ask you if a company is unauthorized, what are they considered? Non-admitted, unauthorized. Know that those terms go together. They do not have a certificate of authority. They are not authorized to transact business in the state. And you may say, well, why are we even talking about this? If they can't transact business in the state, they don't have a certificate of authority. This is only going to be in surplus lines carriers. There are certain insurance companies that are considered surplus lines insurance companies, surplus lines carriers that insure very, niche, specific, rare situations and things. And they are considered surplus lines carriers. They do not need to have a certificate of authority. They are non-admitted, they are unauthorized, but that doesn't just mean that you can go out there and just sell insurance and say, oh, I'm a surplus lines carrier. No, they still have to register and be approved with the superintendent and with the state. Okay, so a whole lot of that on the first bullet point, but wanted to let you know how that all connects, and that does fall in line with the superintendent's roles and responsibilities. So they issue and revoke certificates of authority and licenses. They license and discipline producers if needed. They approve policy forms and rates. They do not set rates. Okay. They love that exam question. And let me explain. So, if an insurance company wants to charge a higher rate, increase their premiums, or change a policy form, change the way their policies are written, they cannot do so as they please. They need to submit that to the superintendent and get them approved or denied. And so the superintendent approves policy forms and rates, but they do not set them. So they could say the superintendent does all of the following except, and they'll list some of these here, and then they'll put set insurance rates or increase insurance rates. No, they do not do that. They only approve or deny them. And that's usually the trick question they throw in there. But of course, they could change them up at any time. So make sure you're understanding the whole concept and all of the duties and responsibilities. They also conduct market conduct exams and investigations. So they will go in and examine and investigate insurance companies, records and things like that. Consumer protection, as we said, that is the number one job and role and focus of the superintendent. They investigate complaints. So if a customer or another agent, things like that, want to report a complaint, they can do so on the Department of Insurance for New York's website, and the superintendent and their team would go and investigate those. They enforce insurance laws and help educate the public and protect the public. And then also solvency oversight. The superintendent examines insurers to ensure they maintain adequate financial reserves to pay claims and remain solvent. Solvent just means financially secure. If somebody or if a company was insolvent, so financially secure. If a company were to become insolvent, it basically means bankrupt. All right. So make sure you are comfortable with the powers and duties of the superintendent. Know that they do not set rates. Make sure that you understand certificate of authority and admitted and authorized versus non-admitted or unauthorized. So just a bit of a recap on certificate of authority. What it is the official permission for an insurer, right, insurance company, to transact business in New York State. The superintendent can suspend or revoke the certificate of authority if an insurer violates laws or becomes insolvent. And the requirements are insurers must meet capital, surplus, and regulatory standards before receiving authorization. And if they have a certificate of authority, they are considered admitted or authorized, as we just said. And if they do not have a certificate of authority, they are non-admitted or unauthorized. And we are only going to see that with surplus lines companies. All right, continuing on. Disciplinary actions and enforcement. So, as we said, the superintendent can enforce disciplinary actions, and there are some common grounds for disciplinary actions. There are more that are listed here, but we're going to go over the most important ones, the most commonly tested ones in more detail. Misrepresentation in applications. We're going to go over that in a lot more detail when we get to the unfair trade practices, so don't worry about that right now. Fraud or dishonest practices, demonstrating untrustworthiness, violating any insurance laws or regulations, forging documents or signatures, or misappropriating premium funds. These are some common grounds for disciplinary actions, but we will go over these in unfair trade practices a bit more. Okay, enforcement process and penalties. So, it's kind of how that timeline would go. If the superintendent receives a complaint or identifies a violation, suspects that something's going on, they would begin a investigation, and then they would send out a notice and a hearing date, and the producer receives a written notice and an opportunity to respond. And the notice of hearing must be sent to all interested parties at least 20 days prior to the hearing date. Okay. So, notice and hearing, they must send that out in writing, because in insurance, everything needs to be in writing. Okay. So, notice must be sent out with at least 20 days prior to the hearing date, and written notice, and the agent or company, etc., has the opportunity to respond. Once the hearing has happened, The hearing officer must render a decision within 10 days from the close of the hearing and receipt of all the related materials, minutes, briefs, etc. So decision in 10 days. And the superintendent can issue that based on the evidence presented, and then actions will be taken after that, whether that's fines, suspensions, or revocations of the license and such. So producers have the right to a hearing before license revocation. And again, that hearing must go out 20 days prior. And upon the close of everything, the superintendent has 10 days to come up with a decision. Different types of regulatory actions that can be taken. Suspension, which would be a temporary removal of license privileges for a specified period of time. Okay, so they could suspend a license for 6 months, a year, etc. So suspension is temporary. Revocation is permanent. That is the permanent termination of a license due to more serious violations. The superintendent could also decide to non-renew a license. Superintendent refuses to renew licenses at expiration. So they may be able to continue out wherever they're at within that 2-year period, because license renew every 2 years, but they could decide to non-renew it. Another type of regulatory action would be a cease and desist, and these can go out at any time in the process. A lot of the times they're going to go out before even the hearing, because they suspect a violation is going on, and they're going to send out a cease and desist, which is an order to immediately stop specific prohibited activities. So they could say cease and desist. We think something's going on. Sit tight, and then send out the notice of the hearing or things like that. Or at any other time, they can send out a cease and desist. They can send it out at any time, but generally it's going to be like right at the suspicion or complaint that they've received and such. Additional penalties may include monetary fines up to thousands of dollars per violation. So on top of risking your license for suspension or revocation or non-renewal, you could also get a cease and desist telling you stop doing anything that you're doing. You could also have fines and penalties that can get quite costly. Real world scenario. What happens if a producer violates New York law? The superintendent of financial services has authority to investigate, conduct hearings, and impose penalties. The producer must receive proper notice within what time frame? 20 days prior to the hearing. And they have the right to defend themselves before final action is taken. Enforcement ensures consumer protection and maintains integrity in the insurance marketplace. Okay, so unfair and prohibited practices. So while there are multiple ways that an agent or an insurance company could be violating the insurance code, the exam really wants to know that you are familiar with unfair and prohibited practices. And there are several. We're going to go over a couple on this slide and the next slide and make sure that you are comfortable with the terms there, because these are the most common tested ones. You're going to want to make sure that you understand them and their definitions and can easily answer any questions on them. So, New York law prohibits specific practices that harm consumers or create unfair market conditions, right? Because they are there to protect the public. So many exam questions test whether an action is allowed or prohibited. So the first one is misrepresentation. Misrepresentation is making false or misleading statements about policy terms, benefits, or an insurance financial condition. You are misrepresenting policy terms, maybe saying this policy covers everything. There's no policy in the world that covers everything. Or, you'll for sure get this payout, things like that. Or about the insurer's financial condition, making it sound like maybe they're in a better spot than they are when maybe they're on the brink of becoming insolvent. Okay. So misrepresentations are usually about the agent themselves or the company or policy that they represent. And it's usually um, false and misleading good things, right? It's usually talking in an exaggerated, misrepresented way about themselves or the company they work for, the policy. So it's usually lying, saying things are too good. Okay. On the other hand, we're going to skip false advertising for just a second. Defamation is usually speaking bad and about someone else. Okay. So defamation is also making false statements, but these are ones that are meant to damage an insurer's reputation or financial standing. Saying, oh, don't go with that company, they're going bankrupt. Um, or don't sign a policy with, Agent Smith across the street. I hear he's a drunk. Even if it's true, you can't say it. It's defamation. All right. So make sure you understand the difference of those two. Now, false advertising is also making false or misleading statements, but in marketing materials, in advertising. So make sure you read the question in its entirety, because if you see false or misleading statements, and you want to jump and go, oh, that's misrepresentation. No, continue to read on. Is it about the policy terms and benefits or the insurer's financial condition? Then it's misrepresentation. Is it statements that are false and damaging to another insurance company or another insurance agent's reputation? Then that would be defamation. Is it false or misleading statements in marketing or advertisement materials? Then it would be false advertising. So make sure you are comfortable with those three different unfair and prohibited trade practices. They can sound similar if you read it too quickly. So make sure that you know those specific differences. Some other prohibited practices that you could be tested on and you want to be comfortable with is unfair discrimination. It is treating individuals differently based on race, religion, national origin, or other protected characteristics in underwriting or pricing. Okay. Now, insurance is discriminatory by nature in a way, not like this, not for race, religion, national origin. That's never allowed in any instance. But they can charge different rates for different classes. Now, not meaning a racial class or religion class, things like that, but young drivers. All young drivers would be considered in the same rate class. Maybe versus experienced drivers with good driving records. So those are considered the same rate class. There's different rate classes for people who are married versus unmarried. These are things that they can statistically prove or are generally statistically true. So generally, young drivers, new drivers have more claims, more accidents than experienced drivers. There's statistics that show that somebody who is married is generally a safer driver as well. In life insurance, women have longer life expectancies, okay? But these people all fall within one class. Married people is considered the same rate class. Now, what they cannot do, young drivers, same rate class. Experienced drivers, same rate class. people within a specific, geographical area. There may be areas that have more accidents than others and such. What they cannot do is discriminate within the same rate class. Now, we can definitely never discriminate for race, religion, national origin ever, but they can trick you up here in the questions. So that's what I want to say. They can say all of the following are prohibited practices except, and you're reading through and they all look like prohibited practices. But it may say something like charging a different rate for policy holders in separate rate classes. So you could see like charging a different rate and things like that and going, well, that's unfair discrimination. No, this is the part, the separate rate classes, that makes it not discrimination. Now, if they said charging a different rate due to race, religion, or national origin, then of course, absolutely, no matter what rate class they're in, that is unfair discrimination. But the reason why I wanted to dive into that a bit is that is generally the one that they throw in there when they're trying to do all of the following except, and that question just catches people up all the time. So I wanted to dive into that one a little bit. Okay. All right. Rebating. Rebating basically equals bribe, and it has to be of monetary value. So offering anything of value not specified in the policy as an inducement to purchase insurance. Cash kickbacks, gift cards, first month's premium. None of that is allowed. You cannot say, I'll pay your first month's premium if you come and sign this policy with me. You cannot say, I'll give you $50 if you sign this policy with me. Cannot offer them something of monetary value as an inducement. That's the word that they like to use, inducement or induce, which equals bribe, which equals rebating. If you see any of those terms, the answer is rebating. It is not allowed. Now, rebating is prohibited even if the consumer requests it. Gifts of a nominal value may be allowed. So you can offer small incentives and generally more for getting them to come over and get a quote, not to purchase a policy. So I actually worked for a large insurance company that's, all over the country. And they actually did a promotion where they gave all of us agents $10 Visa gift cards that we were allowed to pass out for referrals. So we could say, like, thank you, Mr. and Mrs. Customer. If you know anybody that might also, be interested in getting a quote with us and you send them our way, I'll get you a $10 Visa gift card. So if they sent somebody there, we would give them a $10 gift card just for the referral, whether or not that person got a policy with us or not. So we couldn't give it to them based on them signing a policy, based on them actually coming over and purchasing a policy. They could come in, get a quote, and walk right out the door, and they'd still get the $10 gift card. Now, they're not going to necessarily ask you that on the exam, but the reason why I'm explaining it is because in case you've seen it in the real world and you're like, oh my gosh, I'm going to report all these agents for rebating, there is that kind of fine line, a little blurred line. You want to be careful. It is the number one way that agents get in trouble in the real world. But it is also the number one question when it comes to unfair trade practices. I can almost guarantee you're going to see a question on rebating. So just know that it is not allowed. Offering anything of value not specified in the policy as an inducement, as a bribe, something that makes it more attractive for them to come close this policy is not allowed. It is considered rebating, right? There are also unfair claim settlement practices. So you can also get in trouble for failing to promptly investigate claims, denying claims without reasonable basis, or not paying claims in good faith or within an appropriate amount of time. They could say all of the following are unfair claims processes. except, and they say denying a claim. That's not true. You can deny a claim. Claims get denied all the time, right? If the insurance company just paid out every single claim that came through, they would go out of business, right? But if it says denying a claim without reasonable basis, that's when it wouldn't be allowed. Right? So just make sure you're reading the questions and answers thoroughly. All right. Fines and penalties. So, violations of New York insurance law carry significant financial penalties and other serious consequences designed to deter misconduct and protect consumers. I can tell you that these are of some of the highest fines and penalties out of any of the other states. I teach these laws and regulations for all the states. New York does not play. All right. So, you do need to know these. You do need to be comfortable with these. Write them down, make your flashcards. They can ask you fines and penalties, and you need to know these. Okay. So, general fines are up to $1,000 per offense for non willful violations, with higher amounts for willful disregard. So even if you didn't necessarily know what you were doing was wrong, which you should, that's why this is so highly tested on, and that's why you're going through this, is because you need to know these things that you are not allowed to do. Um, but even if it was a non-willful violation, you accidentally violated it, you can still be fined up to $1,000 per offense, um, with higher amounts for willful disregard. Okay. Aggregated fines. Okay, so if you did this repeatedly, even if it was non-willful, but you were willfully making this mistake over and over again. Let's say you were paying everybody's first month's premium because you forgot about rebating, um, and it was non-willful, but you just did it on, the last 20 customers. They could consider that an aggregated offense, and that could be up to $50,000. If it was a willful, it can be up to $500,000 in fines. Emergency related, up to $200,000 per willful violation for acts related to covered losses during emergencies. Like I said, New York does not play. These are very high fines and penalties. Don't do them. And then twisting and churning. We are going to explain those in a second. Cease and desist, a $5,000 penalty for failing to comply with a cease and desist order. So if the superintendent sends out a cease and desist order and you keep doing it, it could be a $5,000 fine for that. Now, twisting and churning were not on the last slides for unfair trade practices, but they should have been. So we are going to explain those right now. Twisting is misrepresenting, misguiding, misleading a customer to drop their current insurance and buy yours. Twisting their arms to do a replacement or replace a policy. So you absolutely can sign up people that have insurance policies with other companies. People do it all the time. They switch insurance companies. I actually have it on my to-do list today to call around for some quotes to switch my insurance. But if you were to mislead or misrepresent and twist their arm, is how I used to try to remember it when I was taking the exam, to drop their current insurance and buy yours when you're actually not putting them in a better position, not putting them in a better place, that is considered twisting, and it is an unfair trade practice. Okay. Churning is rewriting policies to get more commission. Churning policies that are already in your pot. Churning stuff that's already in your pot. Just churning all of those policies, rewriting a policy. If there was, it already belongs to your company. You already got paid commission on it, and then like rewriting it. Let's say putting the wife's name first instead of the husband's, just so you can get another commission, or instead of just adding a car, rewriting a whole new policy so you can get paid out at the commission. That is churning. You are churning your book of business just to get more commissions. That is also an unfair trade practice. So make sure that you are comfortable with those. And the fines for those are up to $12,500 for non-willful and $187,500 per willful violation. Those are random numbers, but got to know them, right? Other consequences: licenses actions, as we said, suspension, revocation, or non-renewal. You can also face criminal charges. Violations can lead to misdemeanors or felonies for fraudulent acts. Civil actions: Attorney General can bring lawsuits for broader consumer relief. Key exam focus: distinguish between willful versus non-willful violations. Understand penalties for specific prohibited acts, such as twisting and churning. And know the superintendent's powers in enforcement. All right. Practice scenario: unfair practice. Is this allowed or prohibited? An agent tells a prospect that a competitor's insurance company is nearly bankrupt to convince them to switch policies, even though the competitor is financially sound. Right? What would that be? That would be defamation of an insurer. Now, it could sound a bit like twisting, but because they actually said that they spoke of their financial standing, that's what makes it defamation. And that is a worse unfair practice than twisting or churning, as defamation can lead to much higher fines as well as civil cases, things like that. So, talking about the other company's financial condition or speaking about them negatively makes it defamation. All right, now agent licensee responsibilities. Agent and producers or anybody with an insurance license and their responsibilities. Once you are licensed and you go work for an insurance company, that insurance company appoints the producer to represent them. And they actually need to file that with the superintendent. And while you are working for them, you are considered in active status. You are selling and servicing policies. Once you no longer work for that company, if you were terminated or decided to leave and that relationship ends, if you are terminated, a notice is required. The insurance company must, in writing, because everything in insurance needs to be in writing, notify the agent or producer. Okay. And then they must also report to the Department of Insurance and the superintendent, and post-termination records and responsibility transfer. Generally, your records are going to maintain with the company that you work for, depending on your situation. They may be going with you, but generally they're going to stay with the insurance company because you represented them and they need to keep those on file and such. All right. Some key responsibilities of an agent or producer. Fiduciary duty. I like to think of the F in fiduciary as the F in financial. It is the financial responsibility of an agent. Okay. Producers must handle premium funds as a fiduciary, keeping client money separate from personal funds. So, fiduciary is when you are handling premium funds. Okay, premium funds and claim funds never belong to the agent. Okay, if a customer comes in and hands you a check for their policy, um, you cannot go use that money to buy lunch for the office. You cannot take your commission right out of it. You need to remit it. So, remit, which means get money to the insurer. You need to make sure it goes into the proper place for them to receive it. When I owned my insurance agency, every day we had to drop off a deposit at the bank. We had specific like deposit slips and everything, and it went into that insurance company's bank. And we had a fiduciary responsibility to do that every day at the end of the day. We also had strict timelines. Like if it wasn't there within 3 business days, we could start getting in trouble, things like that. And we need to keep that money in a separate trust account. Okay. You cannot keep it in your same business bank account. Right? That would be considered commingling of funds. You cannot put them in the same place. Controlled business. Producers cannot write excessive insurance on themselves, family, or business interest. Okay, so this is like only writing it on self and family or friends. Okay, so you're absolutely going to write a policy on yourself. You're going to write policies on your friends and family, right? Those are your best first customers. Okay, but basically, you cannot get an insurance license just to write insurance on yourself, family, and friends, and then never for anyone else. That would be considered controlled business. So there has to be a fair mix of other clients in your portfolio, other people in your book of business. They're going to generally be a little bit more lenient on that when you first get licensed, because again, that is your warmest market, is your friends and family. And then, but within a year, 2 years, there's going to need to be a nice mix of both. You cannot get licensed to sell insurance only to make commissions on your own policies. Commission sharing. No license equals no commission. Yeah. Okay. You cannot share commissions with somebody who is not licensed. If they say, Brittany at the front desk only does clerical work and she brings in her parents to get a policy and you share commission. Unless the question clearly states that Brittany is licensed, do not assume that she is. You cannot share commissions. No license, no commission. Okay. License display. License must be available for public inspection at the producer's place of business. You must have your agent license available, and if it is a business, you need your business entity license as well. Generally, the agent's going to have it up on the wall, but it needs to be there to be furnished at request of the public or the Department of Insurance. Record keeping. You must maintain records for required periods. Superintendent may examine books at any time. So, just a bit of a recap on certificate of authority. What it is the official permission for an insurer, right, insurance company, to transact business in New York State. The superintendent can suspend or revoke the certificate of authority if an insurer violates laws or becomes insolvent. And the requirements are insurers must meet capital, surplus, and as I have said before, New York does not play. That time frame is 6 years. That is one of the longest amongst any of the states. You must maintain records for at least 6 years. So any claim forms or policies, applications, things like that, you need to keep on file for at least 6 years. Because the Department of Insurance can go in at any time and they need to be able to furnish those records. You must have them on hand. Termination notice, as we said before, if an insurer decides to terminate an agent or an agent leaves, they must notify the superintendent, and that must be within 30 days. Generally, all notifications are going to be in 30 days. I always say, too, in insurance, when in doubt, pick 30 days. However, when we were talking about the notification of hearing, that is 20 days. Okay, now who owns the client records? When we were talking about after termination, figuring out the retainment of records, who owns the records. During the active relationship, the insurer typically owns policy records, but the agent maintains copies for servicing. After termination, records generally belong to the insurer. The agent may keep copies for their own renewal rights if allowed in their contract, but it is generally who owns the records for the testing purpose, the insurer, not the agent. Exam tip: licensing versus appointment is frequently tested. A license allows you to sell, an appointment gives you the authority to represent a specific insurer. So once you are licensed, yes, you do have the ability to sell, but you generally need to be appointed with the insurance company that you represent, or if you are a broker, then you would be appointed with multiple carriers. You need to be appointed with the insurance company in order to sell their policies, okay? And you can't just make up your own policies. Those would have to be approved, right, by the superintendent. So once you pass your test, you cannot just go out and start writing policies. You, one, need to wait for your license to be approved and issued, and then generally you need to get appointed with an insurance company. All right, fraud, privacy, and consumer protection. Insurance Fraud Prevention Act. You need to know this. The New York law criminalizes insurance fraud, including false claims and application misrepresentation. So, the New York Insurance Fraud Prevention Act is the title of the act that criminalizes fraud. It is what, there's certain laws and penalties and things like that for insurance fraud. It's going to be even worse than unfair claim practices. And fraud can also face felony charges, things like that. And the Insurance Fraud Prevention Act is the act in place to monitor and enforce that. There's also a Consumer Privacy Act, which states that producers must protect non-public personal information and follow disclosure requirements. So they could say, what is it called when producers protect non-public information and follow disclosure requirements, or what is the name of the act? And that is the Consumer Privacy Act. And then there are different protection standards. There are regulations that ensure fair treatment and safeguard consumer rights throughout the entire insurance process. And of course, that is going to be monitored and maintained by the superintendent. Federal regulation overview. While states regulate insurance, there are federal laws that apply in specific areas. Okay, so everything we talked about was New York state laws and regulations, but you do need to know about a couple federal regulation overviews that are also above and beyond the state of New York, and that is the Fair Credit Reporting Act. This regulates the use of consumer credit information in underwriting and requires disclosure when adverse action is taken. So you just need to know what the Fair Credit Reporting Act is, what is it there for, and it is to protect the regulation of consumer credit information. It requires certain disclosures if adverse action is taken. That is the Fair Credit Reporting Act. Fraud and false statements is also monitored at a federal level. Federal law prohibits making false statements to influence insurance transactions across state lines. So, on top of regulated in New York, if you were doing it across state lines, it may become a federal act, and much more severe penalties, etc. And the 1033 waiver concept. Certain individuals are prohibited from insurance activities due to criminal convictions. Waivers may be granted in limited cases. So, there are certain criminal convictions that could stop somebody from getting an insurance license. If they were able to still get their insurance license, they would need a 1033 waiver, and that would be granted in very limited cases. And that would have to be, that's a federal regulation. All right, so just make sure that you are comfortable with those. Generally, you're going to be asked about the Fair Credit Reporting Act. All right, so that is the general Part 1 laws and regulations that are common to all insurance lines, right? Now remember, if you are taking the New York Property and Casualty exam, you're going to want to watch Part 2, which I will have linked in the description, or Life and Health Part 2, because everything we just went over is going to be tested on all insurance exams. There are going to be some specific life and health ones or specific property and casualty ones, which we go over in Part 2. But let's take a quiz together and see how we do before we wrap up this video. So I will go through them, and then we will go through the answers together. If you need to pause the screen, go ahead and do so. Number 1, which of the following best defines a producer? A, someone who underwrites policies. B, a person who sells, solicits, or negotiates insurance. C, an insurer's claims adjuster. Or D, a risk manager employed by a business. Number 2, what is the maximum duration of a temporary license in New York? 90 days, 120 days, 180 days, or 1 year? Number 3, an agent must notify the superintendent of an address change within 15, 30, 60, or 90 days. Number 4, which action would be considered rebating? A, offering a discount approved by the insurer. B, giving a $50 gift card as inducement to buy. C, explaining policy benefits accurately. Or D, providing required disclosure forms. Number 5, who has the authority to issue a certificate of authority? The governor, federal insurance regulators, the superintendent of financial services, or D, the state legislator. Number 6, an agent represents which party in an insurance transaction? A, the insured. B, the insurer. C, both equally. Or D, the state regulator. Number 7, making false statement about a competitor's financial condition is called A, twisting. B, defamation. C, rebating. Or D, discrimination. Number 8, premiums held by a producer must be treated as A, personal income. B, operating expenses. C, fiduciary funds. Or D, taxable commissions. Number 9, the superintendent may examine an insurer's records to ensure A, competitive pricing. B, solvency and compliance. C, maximum profitability. Or D, federal tax obligations. Number 10, which federal law regulates the use of consumer credit information? A, McCarran-Ferguson Act. B, Fair Credit Reporting Act. C, Graham-Leach-Bliley Act. Or D, Dodd-Frank Act. All right, let's see how you did. Number 1, the answer was B, a producer sells, solicits, or negotiates insurance. Right, that means that they are an agent or a producer and they need to be licensed. Number 2 was C, temporary licenses last up to 180 days and only in the event of death and disability of a producer for business continuity, and they cannot be renewed. Question number 3, address changes must be reported within 30 days. Question number 4. B, offering inducements not in the policy is rebating, right? That $50 gift card to get them to sign the policy. That would be rebating. Question number 5, the answer is C, the superintendent issues certificates of authority. Question number 6, the answer is B, the agent represents the insurer, right? The insurance company you work for. Question number 7, the answer is B, false statements damaging reputation is defamation. Question number 8, the answer is C, premiums are held in a fiduciary capacity. Question number 9, the answer is B, examinations ensure solvency and compliance. And question number 10 was B, the Fair Credit Reporting Act that governs credit use. All right, so when answering your New York regulations questions, identify who is acting. Are they asking about the producer, the agent, the insurer, broker, superintendent? Make sure that you read those carefully. Determine if an act is allowed or prohibited. Decide if it is state or federal authority. Stay focused on concepts, not just statutes. The exam test understanding of regulatory principles and their practical application. You have got this. Just focus on those numbers and everything we went over here. Watch the part 2 for your specific line. Make sure you download the workbook if you'd like to, the fill in the blank study along workbook with the videos. You can get those on our website at fastpassuniversity.co. That is .co. And please take a second to subscribe. It helps our page a ton so we can get in front of the people that need these. It'll also notify you when we drop new videos, which we are dropping new videos every week after we roll out all 50 states and Washington, D.C.'s laws and regulations. We will be dropping the entire exam content for free for life and health and property and casualty on our YouTube channel. Everything you need to know to pass any insurance exam, always free right here on our YouTube channel. So please hit subscribe so you can get notifications for those. And I will see you in part 2. Good luck. And as I have said before, New York does not play. That time frame is 6 years. That is one of the longest amongst any.